Hello, everybody, and thank you for joining us today for a walkthrough of your EDC Credit Insurance policy. Joining us today is one of our credit insurance underwriters, Josanne Pinault.
Thanks, Chris. Happy to be here.
And from our special risks team, Debt Services Manager, Helio Alves.
Hi, Chris. Excited for today. Looking forward to the presentation.
My name is Chris O'Donnell. I'm a Senior Relationship Manager with EDC. Over the next 45 minutes, we'll be taking you through a number of topics related to your credit insurance policy. First of all, we'll be talking about who we are, who is EDC. Josanne will take you through an overview of the credit insurance policy. Helio will take us through the steps to take when things don't go well with your buyers and you have to engage our claims and recoveries process. And then lastly, I'll be sending you home with a bit of homework in order to better understand your policy. But first of all, who are we? EDC is a crown corporation dedicated to helping Canadian companies of all sizes succeed in global markets. In 2019 alone, EDC helped generate about $64 billion in Canadian exports, direct investments abroad, and domestic business. That's equal to almost 5% of Canada's GDP and contributing to more than 500,000 jobs. And we've been doing this for a long time. Since our founding in 1944, EDC has helped stimulate about $1.5 trillion of Canadian exports and investment. EDC does this through a variety of trade facilitating solutions. At EDC, we support Canadian exports with financing, knowledge, expertise, connections, and of course, risk mitigation. Now, on that latter point, risk doesn't stop when you are with EDC. However, you can rest assured that should smooth waters turn rough, EDC will be there. So in order to learn a little bit more about the credit insurance offering, I'd like to welcome Josanne once again and pass the baton over to you in order to get a better feeling for how the policy works and how best to use it.
Thanks, Chris. So as previously stated, my name is Josanne Pinault, and I am a credit insurance underwriter here at EDC, and I'm joining you today to discuss the credit insurance product. But before I jump into the nitty-gritty of the actual product, I would like to first set the global stage. That, of course, none of us operate in a silo. Every business is impacted by macro and micro global economics, and this is part of our everyday business. We all know this. So throughout recent history, we have had to weather many storms, whether that was sticky inflation, slow economic growth, tighter financing conditions, war, and other conflicts. Some that come to mind in recent memory that I am sure we can all easily recall are the COVID-19 pandemic, the Russia-Ukraine conflict, and the 2008 and 2016 economic crises. Now, concurrently with these global conditions, when conditions like this do happen, corporations are economically impacted and fall under financial pressure. Credit quality then erodes, and we begin to see a sharp uptick in defaults and insolvencies. But credit quality eroding is not just evident in tough times, but can happen whenever and often very unexpectedly. And the last point I'll touch on is related to, of course, financing rates. Rates go up and they go down, as we are all very aware of today. The impacts of higher benchmark financing rates can squeeze entities globally, leading to slower economic and corporate growth and an inability to pay when due. But all of this is to say is that credit insurance acts as a key mitigant when transacting in the global space. When financial and economic difficulties do arise, EDC steps in to ensure that your business is supported and you are able to continue transacting. Now, of course, there are the global risks that impact your ability to do business, and particularly these risks are amplified when you sell your goods internationally. You expose yourself to enhanced credit risk. And risk can happen, of course, at any time. Insurance is there for those sudden, unexpected losses. For example, even if you know your client well and you've done business with them for a long time, many, many years, they can still run into financial difficulty, leaving them unable to pay you. This situation does happen to our policyholders and often, more often than not, catches them by surprise. So with credit insurance, you're actually protecting your revenues and profits by mitigating those unexpected losses. Accounts receivable often represent more than 40% of your assets on the books. These are important assets to protect, and a bad debt can make the difference between a loss or a profit at the end of your fiscal year. And ensuring your accounts receivable in both the good times and the bad is a wise way to manage your overall credit risk. It can help secure your cash flow by protecting you against non-payment. And as we all know, cash is king. And further, protecting your revenues and profits, it delivers values to your investors. Your investors may be more confident knowing that you have a credit insurance policy with EDC. And did you know that EDC also offers contracts coverage for highly customized goods? So you could actually be covered for your WIP or work in progress in the case of contract cancellation. So another benefit of protecting your sales with insurance is that you would also be minimizing wasted time to recover a bad debt. Companies who self-insure can spend a lot of time and money in the recovery effort without any certainty of a positive outcome. In a bankruptcy situation, unsecured creditors stand behind secured creditors in the claims on their assets, and recoveries in a bankruptcy proceeding are typically very low. We're talking cents on the dollar. Some examples of a cost that can be incurred to recover a bad debt, include those lawyer fees, travel fees, or fees to collections agencies. But my esteemed colleagues in our special risks department are experts in loss mitigation, recoveries, and of course, debt management, and are there to help you minimize those losses. And lastly, insurance allows you, most importantly, to focus on growing your business. With a credit insurance policy, EDC will be taking on the risk associated with your receivables so you can focus on your business strategies and execution. Think big. We're talking new markets, new buyers, and extended payment terms. Great. So as Chris had previously touched upon a few minutes ago, credit insurance can also provide you improved access to financing. So you can leverage the policy to get more financing from your bank, as they may actually look more favorably on a business whose cash flow is secured by a credit insurance policy with EDC, which is a AAA rated enterprise. So your bank may actually margin against up to 90% of the value of your accounts receivable, as EDC covers up to 90% of your insured losses. So your financial institution could feel more confident extending or broadening your access to capital markets for you to grow your business. Your bank can actually be formally named as a beneficiary on the policy. It's very easy to do this. You would just be adding what's called a direction to pay to the policy. And this is requesting that proceeds of a claim be directed towards that assignee. Also, good news, if you do factoring, the policy may improve the terms of your factoring contract as well. And you do this by adding a tripartite agreement to the policy. Again, this would be formally naming the financial institution that actually intends to purchase those receivables that are insured under the policy. The financial institution is actually then assigned the rights under the policy with respect to those receivables.
So, Josanne, this is why we see policyholders come to us and insure very, very strong credits at times. Companies that, in theory, you wouldn't be concerned about non-payment, but rather because it gives them an extra borrowing power, and it's worth the cost of covering them in order to get that upside benefit.
Exactly. Great point, Chris. It's the point that definitely needs to be repeated, that the actual credit insurance policy can do more than protecting just against non-payment.
So I'm interested to learn more about those benefits that are other than getting paid in case you don't get paid. Could you tell us a little bit more?
Sure, Chris. So at the end of the day, insurance is it's really there for you, the policyholder, to be more competitive, because with an insurance policy, you're actually able to offer deferred payment terms to your customer rather than asking them to pay up front And of course, by offering these more attractive selling terms to your clients, you continue to build those mutually beneficial relationships and really solidify yourself in the supply chain. We also encourage you to leverage your policy to grow and develop in new markets, knowing, of course, that your accounts receivable will be protected. And of course, ultimately, as an export credit agency, EDC has the data, expertise, and people in those foreign markets to help you. We can actually help you stay informed on supply chain data and foreign buyer activities, as well as you are able to get access to credit risk expertise and analysis, market knowledge, and economic insights via EDC's website called the Export Help Hub. This is a fantastic tool that I'm going to ask Chris to jump in here and explain for our audience today.
Absolutely. So one of the benefits of being with EDC is that you have access to our on-site expertise. So we have a lot of people who are very knowledgeable in sectors, in markets and market risk, in sector opportunities, if you will, as well, operations in terms of how to do business. And that's all consolidated on our Export Help Hub. So this is an online platform where you log in and a lot of information is readily available at your fingertips. And information that isn't readily available can be requested specifically. So that can be as broad as tell me about doing business in Europe to what permit does my buyer need in order to import my goods. So once again, this is all available on edc.ca through the Export Help Hub. And I strongly recommend that you take advantage of this free service. Now, Josanne, you've walked us through the benefits of the credit insurance policy. So, of course, you get paid if we pay you if you don't get paid. You can borrow against those receivables. So it gives you access to working capital, gives you a little bit more muscle when it comes to negotiating your muscle and confidence, if you will, when negotiating your payment terms. Tell me, how do we determine what we charge for all this? How is premium determined?
Great question, Chris. So, of course, how is premium determined is one of our most asked questions. So, premium is actually influenced by more than just claims. For example, generally speaking, the more volume you insure, the lower the rate. Note, of course, that down payments and prepaid sales are not considered insurable sales under the policy and are thus excluded because there is no risk of non-payment on these sales. We too consider the actual profile of the industry that you're operating in. For example, the retail industry, mining industry, and the lumber industry, they all have different associated risks, and those are taken into consideration when we're actually underwriting the policy. And of course, rates are also influenced by the risk of the country or the countries in which you are doing business in, and the individual risk associated with your buyers in your actual portfolio. And on the whole, if you have longer or more stretched payment terms, the risk is greater, and this will have an upwards impact on the rate. But often, adding a deductible to your policy can actually provide some rate relief. And one of the last things that we take into, I'll point out today that we take into consideration is that the actual policy type is taken into consideration. And this is actually a twofold point. So first, we look to see if the policy is a full book portfolio coverage or a select book. So a full book coverage provides insurance for your full book of sales, while a select book insures a select number of formally approved buyers under the policy. So select books are typically more expensive as riskier customers are the ones that are insured, and thus the portfolio of the insured buyers leans more towards higher risk. And the second point for the actual policy type is that we assess if you have a receivables policy or a costs and receivables policy, also known as a contracts policy. Speaking at a high level, the receivables policy protects a policyholder from losses due to non-payment from a buyer after actually shipping the good or rendering the service. While on the other hand, the costs and receivables policy, again also known as a contracts policy, protects the policyholders from losses due to non-payment from buyers, including those losses sustained during the pre-shipment or work in progress period. So premium rates are typically higher for contracts policies, as again, we're not only covering the receivable itself, but we're covering the work in progress. And Chris, I'm going to ask you to jump in here to provide our audience with an example of a good or a service that would actually qualify for contracts coverage.
Absolutely. Thank you. So we often see costs and receivables policies, once upon a time known as contracts coverage. We see that typically applied to manufacturers or other types of industries where there's a lot of upfront costs and no real salvage value. So for example, let's give an example of a company that's won a contract with a major automotive manufacturer. This company has an order for a specific bumper type. So of course, the company goes out, they buy their raw materials, they pay, they pay their labor, they pay for new machinery, et cetera, and they start manufacturing. Now they're sitting on inventory, they're sitting on work in progress, et cetera. And then the automotive company decides that they don't want to pursue with that model and they cancel the order. So while the company has not shipped anything, which would trigger your receivables coverage, they're sitting at a loss because they have incurred all of these upfront costs. And under costs and receivables, once again, sometimes referred to as contracts coverage, those losses would be eligible. So the money that you paid into your labor, the raw materials that can't be redeployed, the inventory of bumpers that are sitting there, very difficult to stick a car bumper onto a pickup truck. There's no salvage value for those. So that's a scenario where we would typically see a company come for costs and receivables coverage is those scenarios where there's no salvage value. Important to note as well that if things go perfectly well during the upfront manufacturing period, well, there's still the receivables coverage after the fact too. So it's not simply one or the other. Both are included in that type of coverage. Now, Josanne, I'll go back to your earlier points about how premiums calculated. One thing that came to mind was how important it is when you several months before you renew your policy, how important it is to really look at those renewal forms. If things have changed with how your policy, with how your business is being operated, your volumes, et cetera. Very important to have a look at those. Correct?
Correct. Yeah. Fantastic point, Chris. At the renewal period, we do ask that you please engage and communicate with your underwriter or your relationship manager during the renewal process. This is the perfect opportunity to review your policy and actually ensure that it is set up in an effective and efficient manner to support your business.
Great. Okay. So we've got the benefits. We've got how we determine what we charge. How do our customers pay us, Josanne? How does a policyholder pay us?
Yeah, great question. So, of course, this is another question that we frequently receive, and obviously, it is in relation to the actual premiums payment schedule. So, a policy's premium schedule can be typically set up in one of two ways. So, you're either on a fixed premium schedule or a pay-as-you-go premium schedule. For the fixed premium schedule, the expected premium due is actually calculated at the beginning of the policy period based on either 100% or 80% of the anticipated sales. Invoices are typically issued on a quarterly basis, with the first invoice typically being sent out on the first day of the month in which the policy is activated and the first of the month for each quarter thereafter. And of course, payment is typically due within net 20 days. And typically with a fixed premium schedule, within 20 days of the entire policy's culmination, the policyholder must declare the actual sales achieved during the past year. If the actual sales achieved is 80% or more than what was previously anticipated, a fifth, what we call a top-up invoice, will be issued for the review and subsequent payment by the policyholder. And now jumping over to the pay-as-you-go premium schedule, this one is typically only offered to larger insurable volume policyholders. But in a pay-as-you-go premium schedule, policyholders are required to declare their sales on a monthly basis due less than 20 days from the end of the previous month. And each month, premium is then calculated based on those actual declared sales, and an invoice is again issued for payment due on net 20-day terms. Another thing that I'm going to point out for this slide is that another invoice actually separate from premium that policyholders will see is related to credit approval fees. So as the policyholder, you are required to establish credit limits for each of your buyers to be insured under the policy. If you establish a credit limit via a formal credit approval on the EDC online portal, you will be charged a credit approval fee on a quarterly basis, regardless of the actual premium schedule assigned. So regardless if you have a pay-as-you-go premium schedule or a fixed premium schedule, the credit approval fees are charged on a quarterly basis. And you will be charged a credit fee equal to either $7 USD or $9 Canadian per the number of credit approvals actually in effect on the last day of each quarter. And again, these fees are payable as invoice at the end of each quarter. Okay, so the last question that I wanted to answer, which is one that we typically do get a lot of phone calls into our customer care team, is how the policyholder gets notified of the premium and fees due. So the invoices are actually sent to you via automated email. So an important item to note in terms of these invoice communications, and of course, the actual access to the online invoicing system, is that when a policy is originally set up or activated, only the main contact on the policy is added to the billing portal and will receive the emails related to those invoices. So please note that if you are looking to either have someone else manage the premium side of the policy, or you would just appreciate having another contact CC'd on those regular communication emails, please reach out to the customer care team to complete the updates required to have that person added to that portal for you.
Great. Thank you, Josanne. I have a question around the pay-as-you-go type of policy that you'd mentioned. You said that it's for larger sales volumes that are insured through the policy. Do you have a ballpark number of what that means in terms of a numerical amount?
Yeah. Ballpark, we're looking at least $10 million in sales in order to have the pay-as-you-go premium schedule.
Okay, great. So we're really chugging along here. We've got benefits. We've got how premium is calculated. We've got how to pay us. What are we exactly protected against?
Yeah, so thanks, Chris. The overarching concept of credit insurance, of course, is that the policy provides protection against the non-payment of a buyer by an insured event. So actually under the policy, there are several insured events that are covered, and I will be going over these in a bit more detail, but I would like to make note that all definitions are found in your policy's general terms and conditions, and I therefore, of course, strongly encourage you, as long as you and everyone, to review the definitions after this session. So the first of the three events that I'm going to be presenting today are applicable to both the export and the domestic policies, and the subsequent 5 are only applicable to the export policy. Therefore, again, please note that there is a distinction between the two policies. So on both the domestic and the export policies, insured events are bankruptcy, default, and contract termination. Now, specifically for contract termination, it means the termination of the contract by the buyer in circumstances where the termination was not the fault of the policyholder's breach of the contract. I'm going to take a moment to stop here and clarify that, of course, contract termination is only an insured event on the costs and receivables or the contract's policy. So the next 5, again, are only insured events related to the export policy. So these include repudiation. So repudiation, it actually means the failure by the buyer to take delivery of the goods within 30 days from the date that the goods were placed at the buyer's disposal, in accordance, of course, with the delivery terms of the contract. Next, we have currency conversion and transfer. Then we have import and export restrictions, war and related disturbances, and of course, lastly, license cancellation. I'm going to dive a little bit deeper into license cancellation. It actually means the cancellation or non-renewal by a governmental or quasi-governmental authority of any properly obtained license, approval, or authorization specifically issued for the purposes of the contract. So again, this insured event is only applicable under a contracts or costs and receivables policy. So at the end of the day, based on these insured events, like EDC will always strive to give you the best coverage for your business model. So if you do have a particular situation, we will try to find the best coverage that works for you. Do not hesitate ever to reach out to your relationship manager or your underwriter with specific questions or situations. We are always happy to chat.
Great. Thank you, Josanne. I do have a question around companies that may have multiple affiliates. For simplicity's sake, is it possible to add the sales of all of those affiliates under one company's credit insurance policy?
Yeah, this is a great point to talk about. So and then absolutely another fantastic benefit of the policy. So the short answer is yes, with conditions. So we first must confirm that the additional insured being applied for is related to the main insured. And another condition that we do typically consider when adding additional insureds to the policy is if they have export sales of their own. Now, of course, if the Canadian affiliate does not have export sales of their own, they're just domestic sales, they actually may still be considered to be added to the policy on a case-by-case basis. And of course, in reference to the foreign affiliates, we are able to consider adding them to the policy, but this is subject to country legal restrictions and, of course, foreign insurance regulations. To note that when an affiliate is actually added to the policy, their sales are then covered under the policy and subject, of course, to all of the other general terms and conditions of the policy. So in short, Chris, yes, we can definitely consider adding related to companies to the policy. If this is something that anyone on the line is interested in, please reach out to your relationship manager, underwriter, have those discussions.
Tell us a little bit about important things to remember about credit limits.
Credit limits, my favorite thing. Credit limits, credit limits, credit limits. I cannot say it enough. So the previous slide spoke about the insured events. But we, of course, now need to go over how to ensure that you are going to be properly covered. It is of utmost importance to establish a credit limit on a buyer in order to be covered. This is an absolute policyholder responsibility that must be met in order for coverage to be applicable. So a credit limit can actually be established in either one of two ways. So number one, you can formally request a credit limit through the PCI online portal, or two, and only if applicable to your situation, is you can use your discretionary credit limit, again, if that's available to you. The discretionary credit limit is only available for full book coverage versus select buyer coverage. And if you review your coverage certificate, the discretionary maximum amount and the actual methods to use it and establish that limit are going to be indicated on your coverage certificate. And please note, of course, that if you do have both an export and a domestic policy, so a joint policy, that you're actually reviewing both coverage certificates, as the discretionary credit limit may be different between the two policies. So if your discretionary credit limit is available to you, the benefits of utilizing your discretionary credit limit include that you actually don't have to wait for insurer or EDC's approval as you do your own credit risk assessment in accordance, of course, with one of the approved methods, again, found on that coverage certificate. And additionally, because it is a discretionary credit limit and not a formal approval on the portal, you won't be charged a credit approval fee. Again, because there's no formal credit approval in our EDC system. One last point that I'll mention for the discretionary credit limit is when you're using one of these, to please remember to actually request to add that buyer's country and payment terms to your coverage certificate. This is also a requirement to ensure that the sale of your the sale to that buyer is covered under the policy. So therefore, as a quick summary, because I just threw a lot of information at you, the important things to remember is 1, that you please ensure that you establish a credit limit, and 2, that you ensure that the buyer's correlating country and payment terms are listed on your coverage certificate. Again, these are 2 requirements that absolutely need to be met in order for that sale to be covered under your policy.
That's great, Josanne. Thinking back to a couple of slides earlier about how to pay us, you'd mentioned the credit fees that come with it. Now, while a credit approval is very, very important, it's never a bad idea to perhaps quarterly hop onto your portal and get rid of the ones that you're done with, contracts that are completed, clients that you won't be selling to again, just to save a couple of dollars on the credit approval fees.
Yeah, that's a great point, Chris. Vetting your limits before the end of the correlating quarter is a really good habit to get into.
Great. Any tips on what to do when your client's overdue?
Yes, so this is actually the last point that I wanted to make before wrapping up my point of the presentation. So I'm going to leave the audience with one last really important reminder, of course, related to overdues. So please remember that shipments, services rendered, or contracts entered into when a buyer is already overdue by more than 60 days are automatically excluded sales under the policy. It is of utmost importance that you are aware of this condition of coverage to ensure that you are limiting your potential losses. And further, you as the policyholder do have an obligation to immediately notify us, EDC, when a buyer has been in default of their payment obligations to you for more than 60 days for an aggregate amount payable greater than or equal to $100,000. So please write these important reminders down. And of course, as usual, I encourage you to read your policy's coverage certificate, general terms and conditions, and of course, to bring any questions or concerns that you may have to your relationship manager or underwriter for discussion. So that sums up my portion of this presentation, and I thank you for your time, and I'll hand the spotlight back over to Chris. Thank you.
Thank you, Josanne. I'm sure our audience is very grateful for the thorough walkthrough of all things credit insurance, really, the benefits, what it protects you against, everything that goes into it. So again, thank you for that thorough walkthrough. Now, sometimes things don't go as planned, and your buyer can be in default, and you need to engage our claims and recoveries special risks team. To walk us through a little bit about the team and the processes once in those scenarios where things don't quite go as planned, I'll ask Helio Alves now to join us, one of our debt services manager with our special risks team. Helio.
Thank you, Chris, for the introduction, and thank you, Josanne, for the details provided about the policy. I'm here to talk about when things don't go as planned, and that's why we're here. And I'm with the Special Risk Insurance and Trade Warranties team. To understand, we are a team of claims officers and recovery officers. We are called the debt services managers. Our team processes approximately every year about 1,000 claims. And just last year, in 2022, we paid about $52 million in claims to our insured. To understand as well that we, in the last 5 years, have approved about 85% of the claims submitted to our team. So I want to provide you with some details that will help you through a claims process in case that happens. So we'll talk about the loss mitigations and claims timeline now. So to understand, you have 60 days. There is a waiting period of 60 days when your invoice is overdue before you can submit a claim. This is in cases of default of payment, because there are cases of bankruptcy where we don't have the waiting period of 60 days and you can submit the claim right away when you're aware of the bankruptcy. And to know as well that the deadline to submit a claim, it's 270 days after the due date of your invoice. So I'm going to go through some key elements of the claim process and what you need to determine, the documentation that you need before you actually submit a claim. First, you need to know that a loss has to occur, and you have to be able to determine the loss and show the loss to EDC, the amount of the loss. And it has to be an insured event that is covered by the policy. Josanne talked about contracts policy. We have shipments policy where the contracts coverage, the contracts part is not covered. So you have to make sure it's an insured event that is covered, that you will be claiming, and the policy conditions have been met. So that is very important. We'll talk about this a bit further. We'll talk about now the documentation that you need in order to submit a claim. We look for invoices and statement of accounts when you're submitting a claim. That helps us to know what is the amount that you are claiming. The invoices have the details of the goods shipped or services provided. Very important, we need proof of debt. We need a dated purchase order or signed, a buyer letterhead, or a signed contract. Those are the preferred methods for showing proof of debt that we will require when you submit a claim. As well, sometimes you won't have a purchase order or a contract. It's not always possible to have it. So you can have a written acknowledgement from the buyer, and we will accept that as long as we are able to determine that this is the actual buyer and it's in relation with the claim that you're submitting and the loss that you submitted to EDC. So, for example, if you're exchanging emails with the buyer, making sure it's an easily email that is identifiable by EDC, that is the actual buyer, and that the amount or the order is also mentioned on that email. We do as well need proof of shipment to be shown to us. We accept bills of ladings, delivery slips, and you can also provide delivery confirmations from UPS or FedEx. Those are all documentation that we accept and that require. And for services, because you're not always shipping goods, you can provide us with written confirmation that the services were provided, and then we are able to help with the claim process.
So, Helio,
yes,
very, very important to document.
That is very, very good point, Chris.
Are there other documents that can support you and your team when it comes to making a favorable decision in terms of a claim?
I mentioned, for example, for proof of debt, it's very important. I mentioned the written confirmation from the buyer, as it's not always possible to provide a proof of debt that is a purchase order or contract. So keep that in mind. We also ask for loss mitigation. You have to provide to us that documentation showing loss mitigation. So I'll talk a little bit about this. So good point, Chris. So in this point, what I'm going to talk about is what you need to validate the policy obligations and conditions. Josanne had explained details of what is covered, what you need. So make sure to read, for example, the policy, general terms and conditions, or the cover certificate to be aware of what are your obligations. The policies are not always the same. You have policies that have specific endorsements or specific exclusions. So it's very important to know that. I mentioned this, loss mitigation, you have to demonstrate it. The policy says that you have to act as if you were not insured. And the part of loss mitigation is you trying to recover the amount that is owed to you. So we will ask for that when you submit your claim. A question that comes very often is that, oh, how long is it going to take for the claim to be processed? When am I going to get paid when I submit the claim? Just know that we have 30 days to provide you with a claim decision when we have full documentation. And sometimes it gets confused with 30 days when the claim is submitted, but be aware that it's when we have the full documentation in hand, then we will be able to provide a decision, and we have 30 days to do that. Our team doesn't deal only with claims. There is the part of loss mitigation and recovery, and we can help with that. Just to understand, in 2022 alone, we were able to help with amounts equivalent to $133 million for overdues that were resolved. The overdues, those were reported to EDC and there was no claims. We were able to resolve this without the claim being submitted, without getting to the phase of a claim. We did pay around $48 million. We did recover around $48 million after we paid a claim. But look at the number, look at the difference. So it is really important to report overdues, especially 60 days when it's 60 days past due and for $100,000 or more. It's really important because it does provide us with the time to help you, to provide you with guidance, and to help you with the loss mitigation and be able to recover the amount even before the claim is paid. So there is benefit in recovering the amounts when we pay a claim, because of course you will get your share, EDC will get its share, but the loss mitigation is really, really very important. So we have a service, for example, for free demand letter that can be sent to your buyer. It's a service that is provided for amounts that are less than 100,000, and it's from our partners collection agencies. It's a free service for the first 14 days. So after the first 14 days, if there is still no result, no payment, you can decide to formally hire the collection agency, but just know that it becomes, it's not free anymore, and it's a cost that you will have to take into consideration. And so again, report the overdues, engage EDC, engage our team, and we'll be able to help.
It's a great overview of the benefit that your team provides. It's really not just paying claims. It's significant loss mitigation, preventing to even need to file a claim. It's an incredible service that your team offers before even getting to the claims stage.
Absolutely, Chris.
Now, I know we don't pay every claim that comes into us. Are there a couple of reasons you can share with us that we typically deny claims, so that our audience can make sure that they don't make the mistakes that lead to claims being denied?
Absolutely, I can share that with you, and I'm really happy when we actually pay the claims. We really want to help. We want to help you in the situation where you need to submit a claim. And I mentioned that we, in the last 5 years, paid around 85% of the claims submitted to us. But there are situations where we deny a claim. And just understand that most of these reasons are within your control. Like we talked about documentation, very important documentation, and to be able to establish proof of debt. It includes disputes. Sometimes those are maybe not within your control because the buyer is disputing the debt, but inadequate documentation, that is, if you are documenting the transaction, you will be able to avoid this in case of a claim. Lack of credit information. Josanne mentioned that you need to establish a credit limit, either by submitting a request to EDC through the online portal, or by establishing it yourself if your policy allows you to have the discretionary credit limit. So very important to have that credit limit in place. We do receive requests that we don't see a credit limit, neither by discretionary credit limit. EDC wasn't contacted, so we have to decline the claim, unfortunately. There are situations where the risk is not covered. The example we talked about was contracts coverage. When, for example, you have a shipment policy, but the contract was canceled, there was no shipments, you submitted a claim, And of course, if there was no contracts covered, so in a situation where the claim won't be paid. The claim is beyond the accepted limit or the deadline to submit a claim. We talked about the deadline at the beginning, but just understand that we do receive claims where it's submitted after the deadline. If you're going to find yourselves in situations where it's after the deadline, maybe because you are in discussions with the buyer, they said they will pay, and they end up not paying, just maybe let EDC know, because we can help maybe with repayment plans, and we are aware of what's happening. So there's no change of payment terms or not sending a claim to EDC when the deadline is already passed. The other reason is shipments of services provided when the buyer is already in default of payment for more than 60 days. So Josan had quickly mentioned it. So again, this is one of the reasons that where we see claims being denied. So make sure to not provide shipments or services when you're buyer in default. If you do, there is a risk. Again, if you're going to do that, maybe communicate with EDC. We can discuss about that. So again, most are within your control, and you can actually avoid claims being denied if you follow that.
Helio, before moving on, a question perhaps on the fourth point, submitting a claim after the 270 days.
Yes.
Why would a company wait the 270 days to file a claim when all we require is a 60-day waiting period?
There are different reasons that are provided to us by a company, and sometimes you have a client that you have been doing business with them for a long time. They have been good payers, and you said, well, I will wait because they are promising to pay. They are experiencing some problems right now. I'm sure they will pay. Again, it's just making sure if the amount is $100,000 or more, to report it to EDC, even if you don't want to pay the claim. If it's below $100,000, it's making sure you are continuing with the loss mitigation and making sure you're not going over the deadline. So it does happen. Again, I mentioned this before, but if there are situations where you are talking with the client, they want to pay and you want to wait, maybe advise EDC, be in touch with EDC, because when you're always in doubt, don't forget, you can reach out and we can help. We are here to help. We're not here to penalize you or to try to make things harder for you. Before I finish, I will actually talk about some helpful tips for you to know in terms of loss mitigation. So report any repudiation immediately. So repudiation are these cases where you ship the goods and the buyer is not going to accept the delivery. The policy that says within 30 days, but 30 days can be a long time because costs can increase pretty quickly when you have the goods at the port and you have to pay the merge fee. So immediately contact EDC when you are in a situation of repudiation, because we also have to approve any resale. Because if your goods are there for weeks and you want to avoid increasing costs, you want to resell as quickly as you can to another buyer, let us know, because we have to approve that. And we have to also approve any repayment plan. This ties a lot to changing of payment terms. It's actually one of the we do see claims denied because of change of payment terms. So if you need to change a payment term or extend repayment plan, you need EDC's approval. So let us know, and we will help. Understand again that we are here to help. So if you need to contact us, don't hesitate. We'll be communicating with you and trying to find the best solution for you. We do have services for collection agencies in terms of demand letters. We mentioned that for amounts that are also above 100,000, we will reach out to the buyer directly ourselves. For below $100,000, we have the collection agencies that can help. and understand as well that once a claim is paid, this is a question that actually comes very often. So what do I do now that the claim is paid? How do I help EDC? So you're required as a policy say to help with the recovery as well. But once a claim is paid, we will lead the recovery, even if we only partially paid the amount. So it's good to leverage EDC's expertise for that. So now that was the end of my part in this presentation. So again, if you have any doubts, if you have questions, don't hesitate to reach out. We are here to help. So I will let Chris now continue and provide you with some great details about how we can help you.
Thanks, Helio. Thank you very much for that overview of what your team offers and some of the important things to remember to ensure your claim is paid. There is a world of opportunity out there for your business, significant opportunities outside of Canada, but with that come challenges. That's where EDC can become your partner, be it you need access to working capital for either your day-to-day operations here in Canada or for foreign contract, to win foreign contracts. Risk mitigation, of course, we're pretty well versed in the credit insurance world right now, but there are other means for us to help in terms of knowledge and information. International business brings a lot of opportunities, but it also brings a lot of challenges, and that's where EDC comes in to help. So I encourage you to reach out to EDC, reach out to your relationship manager, consult the Export Help Hub in order to best arm yourself for success in your business. Now, I promised you a bit of homework, and here it is. Take the time to review your policy terms and conditions. Take the time to read your coverage certificate and really understand what it means. If there are any areas where there's confusion, make a note and then contact EDC. Contact your relationship manager, contact customer care or your underwriter. It would be more than our pleasure to make sure that you understand the policy and ensure that you are covered. Lastly, EDC is here for you. Of course, I keep mentioning, and we have all mentioned many times over to reach out to us. This is how you do it. If you need to reach out to your relationship manager, reach out to them directly. If you've got an underwriter, reach out to them directly. Access our website in order to get access to the Export Help Hub for a vast inventory of knowledge and information. Again, EDC is here to help you succeed both on the domestic side of your business and with your international sales. On behalf of Josanne Pinault and Helio Alves, my name is Chris O'Donnell. I want to thank you for taking the time to be with us today and understand your credit insurance policy. I wish you success in your business and in your exporting. Thank you very much.